Just testing the microphone, making sure that everyone can hear me okay. Great. Okay, great. Hey everybody, it's Walter here, and you're here at the How to Use Timed Exits webinar. And I want to thank you, first of all, for spending time here. And if you are here at the recording, welcome as well. What I want to do today is quickly go over, hey, James, welcome. Tony is here as well. Manuel, welcome. Susan and David K. Hey, David. Mario is here. Kyle, welcome, Kyle. And Bruce. And Barry, welcome, Barry. Charles is here. David and Gary, welcome, guys. So, and to the rest of you that are watching the recording, and yep, I see Stephen K is here. Welcome. Thanks so much for your time. And I decided to use a different software just to test it out today. And I know there have been a lot of bugs, so we may not be using it in the near future. And I apologize in advance for some of the issues that have gone through with your registration and things like that. Doesn't look like they've quite worked out the kinks on this, so we may not use it. We may also try it in the future, but I'm not sure if this is the right way to go. So I just wanted to thank you for your patience, because I know for some of you it was a bit of a rough start. So, but we're here. So let's talk about timed exits now. The way that I came to really consider timed exits, I mean, they've always sort of been, I guess you could call a strategy for getting out of a trade, because if a trade doesn't really go in your direction and it just kind of sits there, a lot of traders, like probably you and me, will strongly consider just dumping it and getting out. But it wasn't until I met, and I was working for an individual who, a really interesting guy actually, he essentially was looking for an assistant, sort of generalist. And the reason why, and at the time, all I was really doing was just reading trading books. I didn't have anything to do. And so I went and interviewed with this guy, and he lived in a massive mansion. And what was interesting was he was very diverse in his interests. He had a few businesses. He was very entrepreneurial. And one of the things that he did was he traded. Now, admittedly, he traded stocks, but we got deep into that discussion. And what I found was that he strongly believed in timed exits. And so it wasn't until I met him and started working with him that I decided to kind of test this and get deep into it. And I know that for some people, timed exits is something that you haven't really thought about in terms of a formalized rule list, or like your system. You've got your system down, but do you really know what to do when the market just sits there and doesn't go in your direction? And that's what today's session is going to be all about. So let's go ahead and jump into it. So first of all, what you're looking at here is the New Zealand CAD, and I don't necessarily think that that's the best one to use. I'm open actually to what you guys would like to see. So let me know if you have any pairs that you would be interested in using as an example today. I don't, like I said, I'm not necessarily married to any of these, so it's okay. To me, if we use your example, it's fine. Euro, pound, Aussie, Euro, pound, Aussie yen. We need 2 votes for 1. CAD, Euro, pound. Okay, Euro, pound it is then. All right, let's take a look at this and see what we have. So the Euro, pound. All right, so let me get into what I really want to do is cover 3 basic ideas when you're using timed exits. So let's say that we were in a trade on the Euro, pound, but let's go down to the 4-hour and see if we can get a better looking chart for this. All right, here we go. This looks a little bit more. All right, let's use this one. This is good. All right, so let's say that we're interested in taking a trade on the Euro, pound pseudo kangaroo tail, which is what this is right here. Now, I don't necessarily think this is a good trade, and I know we have the benefit of hindsight, of course, but I'm not sure that this is the best way to go about it, and the reason, or the best trade setup. And the reason I say that is because we actually have, as you can see here, we actually have a sorry, 1 second. The webinar is doing a weird thing. Like I said, this was a test, right? All right, here we go. So the issue with this one to me is that it doesn't. Ideally, this tail would be a little bit lower than this swing low, and what you see is it's not. It's kind of so it's a pseudo kangaroo tail because the open and the close are not inside the previous candle's range. So just for a quick refresher, if you're not aware of, so pseudo kangaroo tail is essentially a almost kangaroo tail. It fits all of the criteria of a kangaroo tail except for the open and the close are not inside the previous candle's range. Now, normally what you would want to see with a pseudo kangaroo tail is you'd want to see the reason why it was unable to make the strict kangaroo tail's characteristics was because the previous candle was so tiny. So generally that's what happens. So here you have a kangaroo tail that fits the criteria, but if it's a really tiny candle like this little sucker right here, let me show you. If it's looking like that, then there's a fair chance that you might get a pseudo kangaroo tail after because it's just such a restricted area. So this one doesn't have that problem because you actually have a larger than average candle prior to your pseudo kangaroo tail. The real issue with this one to me is that you might make an argument that it didn't quite test the level as much as we would like. In other words, we'd like to see the tail hang a little bit lower so that we could extend a bit of that tail beyond the prior swing low. That would be much more likely, in my opinion, to establish a level that you can hang your hat on and say, okay, the market's going to go higher from here. So if we had this much of the kangaroo tail, for example, that we could extend across, but we can't, right? So the kangaroo tail is a little bit high. It's a good looking setup, but it's not a great one, and it's one that I would probably give up on because the 2 prior candles are really strong bearish. It doesn't look like the momentum's slowing down, and because we really didn't clear out the stop losses that were down here when the bulls went long, in this area here. So their stop losses would be down here. So having said that, let's see what happens. Clearly what happens on the next candle is you see the market prints an inside candle and doesn't take out the high. All right, so that's number 1. Then number 2 candle happens and we're going even lower. Okay, so at this stage, we're not in the trade. But let's say that we were waiting the full 16 hours and then boom, we get triggered on this candle right here. We take out the high of our pseudo kangaroo tail and we're in. Now I'm assuming, of course, that you're not going to take any sort of retracement entry on this trade. I know some people would be hot keen to take a retracement on a candle that's this long for a 4-hour candle. And you remember the euro pound generally has a restricted range. It's not like the pound yen or the pound Aussie, or even the pound. It's generally a tighter range than what you see on other pairs. As you can see here, there's essentially 200 pips from here, this part of the chart, all the way up to here, right? So it's, that's not a lot of, that's a pretty restricted range when you're looking at 200 pips from here to here, especially on a 4-hour chart. So let's keep going and see what happens. All right, so now we're sitting on top of this, I wouldn't really call it a bullish candle, but it is a strong candle up, closed a little bit lower than I would have liked to have seen for a bullish candle, and then it comes back down. Okay, now it's sitting there, and it's still sitting there. So at this stage, you have to ask yourself this question, and this is what I like to do when I'm considering taking or using these time to exit strategies. Is the first thing I ask myself is, is it time to get out of this because of the pattern that's happening? So it's not really, so there's a couple ways to do this. Number one is you can say, all right, if it doesn't go after 5 candles, I'm out, right? You can just set a line in the sand like that. And for those of you that need hard, fast rules, back test that and figure it out. Is it 5? Is it 6? Is it 7? What is it? What's that number that you say, look, most of the trades will go in 5 or 6 candles. And if they don't, it's time for me to just pull the plug on this. If I'm not stopped out, let's just get out, right? Now, technically, the market hasn't really closed below this zone that I have drawn at 72.34. So technically, it's still on top of it, just as it was when it triggered the pseudo kangaroo tail, right? So what has it really done? Well, the answer is nothing. It hasn't done anything. So the first way to deal with a trade that's just blah is, number one, is have a hard number of candles. So whatever that is, if it's 5, if it's 8, whatever it is, you have a hard number of candles that after that number, and if the market's not going anywhere, you get out, whether it's a small loss or a small win, it's just over. And, the logic behind this is quite simple. Generally speaking, when you're looking at price action, and if you think of looking at price action as looking at, let's just simplify it and say looking at the line chart. If you think of it, it kind of makes sense that if we're looking at the line chart, which is basically the one moving average on the closing price, right? It's a closing price moving average on the time period of 1. That's what this chart is, right? And you're using these patterns on the line chart to establish your trades, which is, the close is very important when we're looking at naked patterns. Then perhaps you could make the argument that these patterns that you see are only good for the near future, because after the pattern forms and the near future is over, and that near future can be defined by 5, 6, 7, 8 candles, whatever it is, 10 candles. Now you're into a different pattern, right? So let me state that another way, because that might be a little bit confusing when I say it that way. But another way of saying it is, price action patterns, your naked Forex patterns, expire. And so if you get a really clear, clever pattern and you want to hang your hat on it, and yet the market doesn't go in your direction, perhaps, just perhaps, it's time to give up on that pattern and ask yourself this next question, which is, what sort of pattern are we seeing unfold now? Now, I know that can be somewhat difficult when you're in a trade because you have this bias. Often we call it confirmation bias in psychology, which is simple. It's a simple idea with a funny name, but essentially it's this idea that when we have a theory or a hypothesis about something, we only attend to information that confirms that hypothesis. So it's something we have to watch out for as a trader, and why it's so lovely being flat in the market, because if you're flat, you are more likely to look at it with an open opinion, and you're open to exactly what's happening in the market, what you see on the chart rather than what you think. And I know that's difficult even if you are flat, because sometimes, like, for example, I'm very bearish Aussie dollar. So even if I look at an Aussie dollar chart and it looks like the market's going up, I still might have a bearish bias, and I do. I'm aware of that, and so it might be difficult for me to look at this Aussie dollar chart and say, you know what, I want to go long the Aussie dollar here because it's broken out of this zone right here, right? Maybe we get an Acapulco trade here, and the market gives us a little tiny candle today, and then would I go long and target 78.80? It might be difficult for me to do that because of my bias. So we just want to be aware of what our bias is. All right, let's go back to the 4-hour euro pound. So in this instance, we've said, look, I've been in the trade for 1, 2, 3, 4, 5 candles. I'll just wait 7 candles to see what happens. 6, 7. Well, it looks like it stopped me out at number 7, so it's all over anyway because my stop loss would have been down here, and it's over. So perhaps if I had my thing set at 5 or 6 candles, my hard number of candles, that if the market doesn't go in my direction after 5, 6 candles, I'm out, I would have saved myself a bit of grief on this setup. So that's one way of doing it, which is just a hard number of candles. And my suggestion is that what you do is you test this and find out what that sweet spot number is. You might find that it's 5. Most people are going to find that it's 10 or less. Most people are probably not going to say, okay, after 23 candles, I'm going to dump the trade. Because in most instances, if the market's not going anywhere in 23 candles, it's probably come pretty close to your stop, and you're in a consolidation range, and that's kind of what I want to stay away from. My enemy in trading is consolidation. Reversal setups are great. Trend continuation setups are great, but consolidation and just drifting around is awful from my style of trading, and I'm aware of that. So I want to steer clear of those. So let's get into the number 2 thing, which is watch the pattern, not just the number of candles. So in the simplest version of this is you have a set number of candles and you're out if the market doesn't go. But the second way to do this is actually watch the pattern, not the number of candles, right? Now, why would you want to watch the pattern and not the number? Well, again, what we're trying to do here is be open to what's possible. So instead of using a set number of candles and say, look, I trade based on patterns that are going to show me the likely momentum in the near future, and if that momentum doesn't show up on the chart, then I'm wrong and I need to dump this trade. So that's kind of what someone who uses the number candle rule would be looking at. They'd be looking at that sort of logic. Whereas if somebody has instead this idea of, well, I'm in the trade, I think it's going to do this, but I'm going to watch the pattern and see if it's giving me anything else. Well, in this case, what you probably could say, let's say that we did survive this pullback, and for whatever reason, our stop loss was below this swing low instead of the pseudo kangaroo tail itself. So we withstand this. I think we would have withstood this, right? Let's just assume that we did. Yeah. You would have been able to just hold on. Well, the question is this a double bottom? Well, the line charts could be our friend here, and it looks like it could have been a double bottom maybe if we looked at it here. But now that we see this part and it's gone back down, you could argue that no, it's not really showing double bottom anymore, but rather it's showing possible consolidation, especially when you see another pregnant candle inside of, when I say pregnant, I mean it's inside of this candle right here. And then you see this, it's like, okay, now what is the pattern telling me? Well, this is the first candle, and this is a significant candle, that's closed below my zone since this one back here. And when it closed below that back here, it snapped right back up the very next day. So this is the first candle that actually is closed below the zone. All the other ones here have tested it, but this one's closed below it. So in this instance, I would be very concerned that we're going to see the market fall here. And then boom, we come right back above there. So maybe we are going to go long here. Maybe it is going to sit here. Okay, if we clear out these highs here, let's go long. No. Now you get your big bearish candle. It engulfs the last 2 candles. And again, we're basically closing right on the zone. I don't like to make a fine distinction with these things, but this one is, if it hasn't closed below it, it's either right above it or right on it. And then boom, we see it go. So one of the naked principles that I like to follow is multiple touches in quick succession equals breakout. You probably heard me say that before. So what we're talking about here, right, is the likelihood that the market's going to bust through, right? That's the likelihood. And the question that you have is that really the case here? Has it really broken through? Well, it looked like it might have here, and then it looked like it might have here, but clearly when this one happens, it did break through. So by watching the pattern, I'm aware of the fact that, look, this, and you know, it's a little bit late because if my stop loss is down here, I'm stopped out. But the question you have to keep asking yourself is, would I, if I were a trader who is looking instead to go long like I did, instead to go short, would I have taken a short here, right? So you want to flip it around and see the market from the other market participants that you're trading against, the ones that you're basically trying to take their money, right? So what would they be thinking if they're looking at going short? What's the evidence for them, right? And that's the question to ask yourself when you're watching the pattern. It's, what do other people think in this instance? How would they see the markets different to me? All right, and let's get into, so does that make sense? Any questions about that? Okay, cool. How do you know if it's going to... All right, good question. So Jason's asking, how do you know if it's going to break through a zone or if it's going to bounce off of it? You don't know, right? But what you do know is that if you have guiding principles, you can ask yourself, is the market fitting these principles? So one of my principles is a bounce on a zone should happen rather quickly, like this one did. Look how fast the market hit the zone and moved away from it. You know, within 4 candles, it had made a really sharp bounce from this touch here all the way up to this close up here. That's pretty good. And then you get another pullback, and then it keeps going. Well, and compare that to this one. If this is really going to be a reversal trade, which is what I'm saying it's going to be based on this pseudo kangaroo tail, then it really should touch it and move away. At the very least, it should touch it, move away, double bottom, and then go, right? And if it doesn't fit that pattern of a potential double bottom, then it's time to start thinking, all right, we're looking at a breakthrough here. It's going to break through this zone and not respect it. So that's one thing that you might look at as a trader, which is, okay, is it really doing what I expect it to do? So with a reversal trade, things that I'm looking at with reversals, Jason, is I'm looking at things like, all right, is it quickly and efficiently pushing off of the zone? Because that's by definition a reversal, right? Or is it sitting there and just sort of languishing on the zone? Because that to me is behaving much more like a breakthrough. To me, this is a breakthrough because it's just sitting, and it finally goes, right? The other thing is, on a reversal, is you might catch it on the first bounce, and then it pulls back and it double bounces. So a double top or a double bottom. Obviously, very, very common. I'm aware, in fact, over the last 3 years, basically, I am often so patient with these that I try and get in on the double, on the double top or the double bottom, rather than getting in on the first one. And the first touch might actually be the better signal. But because I know that it's quite likely, not always, but quite likely to come back again, if it's, if it seems like there is still some momentum in the opposite direction, I'll just wait for that second touch and then try and hang my hat on that and get an entry off of that. And also, the great advantage of that is you have more market information, right? So if you got in on the first touch, you only know so much about what the market's told you. But on the second touch, the market's actually told you much more here about how it's likely to respect that level. So hopefully that makes sense. But you can come up with your own guiding principles. Now, let's get into the third and final topic here, or rule or guideline that I like to use with timed exits, which is ask yourself this question. Because I strongly believe that you really only have 3 types of markets, okay? And it doesn't matter if you're looking at Apple stock, the S&P 500, or the Euro Aussie. All markets basically have this. There's something going on, and you ask yourself, which phase are we in? Now, what does that mean? Which phase are we in? Well, every market is either in an uptrend. Sorry, I shouldn't say uptrend or downtrend. It's either in a trend, it's in a retracement, or it's in consolidation. And that's it. I would argue that you don't have anything else going on in the markets. So let's tear these apart. Consolidation, the market's going nowhere. Consolidation, you can clearly and easily draw them as a box. Consolidation right here. Market's going nowhere, right? Consolidation right here. Market's going nowhere, right? So when you see those, that's consolidation. Here's even a little mini, well, depends on the time frame. If you looked at this from the 30-minute chart, it would have been consolidation, but I would argue this is something different. Now let's go into the next thing, which is, I'm going to draw an ellipse here. I don't know why I thought that was funny. Just different color. This is what we would say is retracement. The market's going up, it retraces, and then it continues. Here's another one. Retracement. Now, you might argue that it's consolidation within a trend, and that's fair enough. But what I mean by retracement is it's a rest in the trend. So the trend is resting with a retracement. So it doesn't necessarily have to go against the trend. It often does, but sometimes it just doesn't go anywhere. So it's like a mini consolidation, but it's clearly bookended by strong trend candles, right? So these areas are what I would call retracements or non-trending markets within a trend. So trending candles, retracement, trending candles, retracement, and so forth. Whereas consolidation, what you get is a lot more of directionless up, down, up, down, up, down movement. In a retracement, you generally see the market stay flat or go slightly against the trend. And the last thing that we're looking at, of course, are trend explosion candles or strong trending candles. And those are clearly marked here with this arrow, this strong bullish candle there. And there's another strong bullish candle here. And you've got them going down as well. Here's another one. Here's a strong bearish candle here. Here's a strong bearish candle here, right? And so forth. So that makes sense? Yeah. It's quite easy to see. Strong downtrend, really strong. Here's another one actually. I would argue that the far right candle on this chart is a strong trending candle. When we say which phase are we in, basically we're asking ourselves, are we in solid? Oops, that didn't quite work. Are we in consolidation, retracement, or trend explosion? And that's basically it. You're in one of those at all times. So here I would say we were in consolidation, and now it looks like we're back into trend explosion. Consolidation here, trend, retracement here, right? So what will often happen is you might think you're in retracement, but then if it doesn't break out of that, then you're in consolidation. So it's always kind of tricky when you're clicking over from trend and a retracement to consolidation. So what might be happening right here, in other words, what I'm saying is what might be happening here is we're establishing a box. So this could actually be consolidation here, where we've got basically two touches at the top of the box, one touch at the bottom. If we come back down here and make another touch at the bottom of the box, and then back up here, then you say, okay, we're in consolidation now. So another way of saying what I just sort of butchered is this idea that every consolidation looks like a retracement in the beginning. So every consolidating market, in the beginning, you think it's probably a retracement, but actually it's the beginnings of a consolidation. And the clue is, do you have multiple touches on both sides of the box. So I have 2 up touches, and I've only got 1 down touch. If I get 1 more down touch, I can now call this consolidation. Does that make sense? Hopefully that's obvious from looking at it. All right, so what if the market breaks out of the box? You think it's consolidation, but it breaks out. Right, good question. So if the market is in what you believe to be a box, right, but it breaks out, I don't necessarily consider that the market's now trending, or like, oh, I don't say that it's moved out of that directionless market unless I can hang my hat on a retouch of the box. In other words, that's where the last kiss comes in, right? So if the market last kisses the box, then I can go, okay, now we're going, this is it. It's broken out of that consolidation. It's actually kissed it and told me that, see you later. It's no more interest in moving back inside that box. Instead, the market's ready to get away from it. So we'd be looking at some sort of early phase of a trend, perhaps. Now, of course, it could just be setting up a larger consolidation box, but for my purposes in the trade, I'm just going to assume that if it last kisses the box, that consolidation is over, and we're going to start moving and grooving and getting on a trend. So hopefully that makes sense. So it's really for me, it really is the last kiss that qualifies the market transition from consolidation to possible trending again, right? And even if you're wrong, like even if the market just explodes out of the box for a little while, there's still usually plenty of movement there to take profit, even if it doesn't go for 900 pips. And I'm looking at the 4-hour chart here. Like, so it breaks out of this box, let's say. Just because it does that and doesn't go for 900 pips doesn't mean I can't, take a chunk of 180 pips or something like that. So it certainly is possible. All right, so in a nutshell, guys, let me just quickly recap for you. That's basically how I like to look at timed exits. One simple way is if you really want to have rules in front of you and just stick to them, you can have a hard number. And I would encourage you to back test that number and figure out, look, 85% of the time, if the market doesn't go after 7 candles, it's not going to go. So I use the 7 candle rule. The other thing you can do is watch the pattern and decide for yourself, are we looking at something different? So I got into the trade back here, but now that I have X number of candles in front of me, is the pattern developing into something else? Was I wrong, or not necessarily wrong, but now with more information, is the market telling me more about where it wants to go? And the final thing is, which phase are we in? What's the market doing? Is it consolidating now? Is it retracing against the trend and gearing up for another explosion in the trend direction? Or are we actually trending and going strong in one direction? And usually if you use those 3 things, you should be able to put yourself in a good position to pull the plug. Now, you're always going to have regrets. You're always going to have situations, well, I could have done this, I could have done that, and instead I made the mistake and did this. But it's not enough. The real difficulty I think that traders have is when things like that happen and you feel like you made the wrong decision, then you feel like you have to, you're like a politician. Politicians are really good at making laws for the last disaster. So whatever the last disaster was, we'll go ahead and make a bunch of rules and laws and regulations so that that last disaster won't happen again. The problem is there's probably something very different that's going to happen in the future. And the same thing with trading. So, if your last disaster was that you didn't wait long enough for the trade to go in your direction, so then you had a rule that says you're going to wait longer, well, that doesn't necessarily mean that will serve you in most of the situations in the future. It just means that you're sort of bending your rules or adjusting your system to account for, the last result, the last thing that happened, and not the thing that's happening right now for you. So, or what's going to happen next. So it's really a slippery slope when you start designing your system based on the last couple of mistakes that have happened. So that's not even mistakes. I mean, they're learnings, right? So I don't necessarily believe that we should overfit our systems based on what happened recently. So that's my belief anyway. So hopefully that makes sense. Any other questions? I came in late. Can you? Yeah, this is recorded. It'll be posted in the members area, so don't worry about that. I know some of you did pull in late. And like I said, guys, this was just a test this week for this software, and it was a pretty much a failure. So I just wanted to try it out and see how it's going and see if it was something that was worth using. And so I know that a lot of you have had some issues, and I have as well, and I apologize for that. I just wanted to test it out. And so I'm always looking at different ways to, use different tools and stuff, and I just thought we could try it out. But so far, it doesn't look so good to me. So we might just have to go try something else or go back to what we've been using for webinars. In fact, we're gonna have another webinar next week, guys. So I'm gonna go through all of your responses and see what you want for the next webinar, and we'll see if we can put together a webinar based on what you're after. Okay. All right, guys. Thanks so much for your time. I wish you very happy trading. This video will probably be up in a few hours, and I'll post a Asian session update as well right now for you in the Daily Trader. I wish you happy trading, and we'll see you soon. Okay? Thanks for your time. Okay. See ya. Bye, Gary. Bye, Tony. See you, Susan. Take care, guys. Have a wonderful week. We'll see you soon. Okay? Okay. Bye.